I am Nancy Meyer here at C2ES. I'm the Director of Business Engagement, and I'll be hosting the webinar today. First of all, I just want to thank you all for dialing in and participating. We had over 260 folks register, so we're really excited to see that there's a lot of interest in this topic, and really happy to have a great group of experts to talk with us today about how to use scenarios in the context of climate-related financial risk. So, I'm going to start by giving you a little bit of an overview of what we're going to go through today. I'm going to start off with, actually, before I get started on the agenda, let me just do a few housekeeping items so that everyone's up to speed on that. First of all, I just wanted to mention that the webinar is being recorded, and it's going to be posted to our YouTube page, the C2ES YouTube page, after it's been broadcast. And then because we have so many participants, we're going to be using the GoToWebinar chat box for questions, and you can submit your questions at any time online through that chat box, and then at the end of the webinar, when we get to the Q&A session, I will be using those for the moderated discussion. So again, at any time you have a question, just go ahead and put it in that box. So in terms of walking you through what we're going to do today, I'm going to kick things off with some background information about climate-related financial risk and some of the work that we've done in that space here at C2ES. And then we're going to hand it over to our panelists to provide more details on their areas of expertise. We're going to have Amy Myers Jaffe and Kaitlyn Allen, who will discuss a framework for 2-degree scenarios analysis and how they have applied it specifically in the oil and gas sector. Secondly, we have Libby Burnett to talk about some of the work that she's done to translate climate issues into financial costs for several sectors through the work that she's done at True Cost. And then last but not least, we have Mackenzie Huffman with JPMorgan Chase, who's going to explain in greater depth some of the research and recommendations from the FSB's Task Force on Climate-Related Financial Disclosures, as well as the cross-cutting issues and challenges that companies are facing in terms of implementing scenario analysis recommendations. So then after we hear from all the panelists, I'll have a few questions that I'll go ahead and ask. And then, as I already mentioned, feel free to submit your questions at any time as they come up throughout the course of the webinar. So with that, let me go ahead and get started and say a few words about C2ES. For those of you unfamiliar with us, we are an independent and nonpartisan nonprofit organization. We are focused on strong policy and actions to address climate change. Our core mission is to forge practical solutions to reduce greenhouse gas emissions, expand clean energy, and strengthen resilience to climate impacts. We are also known as a convener of different stakeholders, and we produce a lot of publications, which you can find on our website. In addition, we have a Business Environmental Leadership Council. It's one of our unique features here at C2ES. And in my work, in my role here at C2ES, I work directly with our Business Council. And as you can see on the slide, we have many top companies in the electric power, manufacturing, transportation, high tech, oil and gas, finance sectors, among others. We are one of the largest U.S.-based group of companies that's devoted solely to addressing climate change. One of the key benefits of our BELC, which is the acronym that we call it, is that it's multi-sectoral, and so unlike a trade association, companies get to talk with other companies outside of their own industry about climate policy. I also just want to take a quick second to talk about our Climate Leadership Conference, which at the end of the month, C2ES, along with the Climate Registry, is hosting. This is going to be the 7th annual Climate Leadership Conference. It's going to be in Denver. We have a great lineup of speakers. It's an excellent opportunity to network and hear from other folks working on climate and energy and sustainability in various sectors. So you can find more information online at the website, climateleadership.org, and we really hope to see you there. And then speaking of websites, for those of you who haven't already seen it, we just launched a brand new website for C2ES. I highly recommend you check it out. You can find all of our reports, other upcoming events. We have a blog, lots of great reference material. So feel free to log on and check out what we have to offer there. All right, now let's dive into the focus of today's webinar, which is climate-related financial risk. So to provide a little bit of context in terms of where this recommendation on climate-related risk and using scenarios to address it came from. Around the time of COP21 in Paris, the Financial Stability Board, which is a body that reports to the G20, announced the launch of a task force on climate-related financial disclosures, also known as the TCFD, because that's a mouthful to say, although the acronym is also difficult. The goal of this particular task force was to recommend a disclosure framework for climate-related financial risks, and not just the physical risks of climate change, but also transition risks. So the financial risk of moving towards a lower carbon economy. And they convened a bunch of different stakeholders from different industries and pulled together a final report in June of last year, in 2017. And in that report, they issued a single voluntary framework recommended to disclose, for companies to disclose all of their climate-related financial risks. And this applied to financial and non-financial organizations with public debt or equity. The framework included recommendations on reporting on governance, strategy, risk management, and metrics and targets, and also included the use of 2-degree scenario analysis to frame climate risk. So that specific piece of the recommendations is what this webinar is focused on, and Mackenzie is going to chat a bit more about that later in the webinar. But in terms of what we've already covered on this work here at C2ES, back in September, we issued a report that I have up here on the screen called Beyond the Horizon, Corporate Reporting on Climate Change. And we found by looking at the TCFD recommendations that in general, those recommendations we thought struck a pretty good balance between providing transparency to stakeholders and investors who are looking for more disclosure on climate risks, but also provided a flexible framework for companies to report that risk. We did not feel that U.S. regulators in particular were likely to require such disclosures, but companies are likely to be expected to report more and more on these types of climate-related risks and opportunities. We do believe that more work is going to be needed to help companies implement the recommendations, particularly around scenario analysis, again, while we're focusing on this today. And that there are also opportunities and challenges with this, and that's what my next 2 slides are going to cover really quickly. In terms of opportunities, we felt like the TCFD framework would likely result in better understanding and communication about climate-related risks. Companies would be better positioned to take advantage of those opportunities and be better prepared for risks as well. They could be more proactive in terms of investor concerns, or be prepared or stave off potential shareholder resolutions. And investors might also be able to identify opportunities for investing in climate solutions. On the flip side of that, there are also several challenges that we thought with the recommendations. And in particular, I'm going to focus on the ones that are relevant to what we're going to talk about today, that there was a lack of clarity in terms of timeframes that companies should consider. There are also potential legal issues in terms of determining materiality. And on that particular issue, I want to note that we are also hosting a webinar on March 12th at 10 a.m. Eastern Time to really dive into that specific issue on legal ramifications. There's also concerns about appropriate level of detail and how to use scenario analysis appropriately in terms of disclosing that information. So I think I'll leave it with that and try to move forward and get into the meat of the conversation that we have today on our agenda. So before we get started, I just want to give a quick introduction of our speakers. I'm going to tell you a little bit about each of them before I hand it over. So to begin with, we have Amy Myers Jaffe, who is a David M. Rubenstein Senior Fellow for Energy and the Environment, and the Director of the Energy Security and Climate Change Program at the Council of Foreign Relations. So she's a leading expert on global energy policy, geopolitical risk, and energy and sustainability. So she comes with a lot of words behind her name and very well prepared to talk about this today. Along with her, she's going to be presenting with Kaitlyn Allen, who's the president of the Global Affairs Associates. The Global Affairs Associates is a social enterprise that helps clients in all sectors optimize their environmental, social, and governance impact and mitigate social non-technical risks. So that should be an interesting presentation from both of them. Then we also have Libby Burnett, who's the global head of corporate business for TrueCost, which is part of the S&P Dow Jones Indices. TrueCost assesses and prices risks related to climate change, natural resource constraints, and broader ESG factors. So she's been a strategic advisor to global multinational corporations, development banks, investors, and foundations on environmental social issues. And then we also have Mackenzie Huffman, who's Vice President of Sustainability Financing at JPMorgan Chase. She oversees the bank's initiative to supply $200 billion in financing for sustainability projects by 2025. And has a lot of expertise in this area as well. So with that, I'm going to go ahead and hand the floor over to Amy and Kaitlyn. And Amy and Kaitlyn, if you just want to let me know when to move your slides, I'll be happy to do that from my end.
Okay, so we're going to, this is Amy Myers Jaffe. We're going to start with the first slide. So my journey into this topic has been long coming, having taught this subject at major universities, both in engineering departments and business schools. But more recently, I served as an advisor to the chief investment officer of the University of California on these issues. And one of the key issues, I know several of you who are on this webinar, a key issue is if I'm a large investor, like the UC a pension fund and endowment, or similar kinds of organizations, how do I make a judgment about what companies that I'm investing in, whether it's, Fortune 500 companies or beyond, how do I know that their leadership or their management is properly addressing or thinking about the kind of risks that could come either from the energy transition or from climate change in general? And that goes beyond the sort of check the box compliance activities that one might do because one had a shareholder resolution. It really is about signaling the market that you understand these risks and conveying that somehow when you talk about your corporate strategy or when you do your performance reporting. So, why scenario analysis as opposed to some other way of doing that? As Nancy mentioned, Kaitlyn and I have done a lot of work in the oil and gas sector. So you're in the oil and gas sector, why not just say, as a lot of the companies do, when we're making our investment decision making, these are long-term investments, and so we use a carbon price of $40 or $80. And even ExxonMobil, who gets a lot of controversy in the press, uses the carbon price in stress testing their future investments. And then on, transition risk, a lot of companies use the, various oil prices. Will the oil price be high? Will the oil price be low? If you're a business that has to worry about energy pricing, you probably also, when you're doing your corporate planning, stress test investments against changes in the energy price. So, so if we're doing all of that, why would we add this extra layer of scenario analysis? And I would argue the reason one goes beyond what was done, 10 years ago is that, especially in the energy industry, but beyond, there was confidence of certain things. We thought that global economic growth would be roughly in the certain pattern, and we might have a recession for a period of time, but you could kind of forecast for that on an average basis. And people thought they understood where energy costs were going to be and what the regulatory environment was going to be. And people also thought they had a good handle on what technologies were going to be available. And there was a lot of focus on what I call primary energy. Are we going to use coal? Are we going to use shift to natural gas? What's the role of renewables? And, people had these very steady forecasts about how we were going to ease into minor shifts in those choices about primary energy. But as we all know, because we're doing a webinar now and we can all 268 of us be in different locations, and you could be at a hotel on vacation and still attend this webinar. So how is that? That is because technology has become so disruptive to the way we previously had done business. And that is true in the sort of climate risk space. Number one, we can see the risks more clearly in some of the physical risks, but also in terms of some of the disruptions that are going to come. They're very hard to predict and they're complex. Will we have breakthroughs in the following technologies? What will the regulatory framework be? Will the Paris Accord succeed and will it accelerate? Will it decelerate? And so when you're doing business planning, you almost have to have multiple visions of the world, and there's so many complex factors, which we can all see. The U.S. election being one that, if you were doing a scenario, you might not have had that even as a scenario. So, 5 years ago. So the question is, when you're doing scenarios, what you're trying to do is capture sort of what we call new states of reality. So what will the world look like in 10 years or 20 years? And will it look like this or will it look like that? Will millennials turn around and, give up on their urban lifestyles and, move to the suburbs like their baby booming parents and consume goods again? Or are they going to stay in the current path they're in where they're very urban and mobile and, very into spending their money on experiential consuming? So, thinking about those different things, well, those are different scenarios. So under the scenario where all millennials, in the United States, say, or in China, move to suburbs, are they going to drive electric cars? Are they going to take the subway? Are they going to train? Or are they going to take, conventional cars? All of those things give you very different outcomes. And so what you're really trying to do is you're trying to integrate a wider number of uncertainties and then understand how those variables intersect with each other. And by doing scenarios, you don't have to limit the number of variables you're taking into account. You can have one scenario that has a certain regulatory framework, and then you can try a second set of scenarios with a different regulatory framework. And it allows you to sort of come up with, if you could imagine you're writing a science fiction novel and you're going to have 4 different stories of possible plots. And then after you've created that, or you could take, 4 stories off the shelf from the International Energy Agency or some other forecaster. After you've done that exercise, then what you want to say is, how is my company positioned for world A versus world B? And think that through. And that is really sort of the benefits of scenario planning. Because once you understand that, the future is likely to deviate from history. A lot of businesses are like, well, we've always done it this way and it's working for us. Well, what if the future looks different? So when you do the scenario analysis, it allows you to understand, what are the major factors that are going to maybe change your outcomes if point B happens this way or so forth. So going to the next slide, how does that differentiate from sensitivity analysis? So sensitivity analysis is, I'm running my business a certain way and I need to know, will I still be, as profitable if one thing changes? There's a carbon price, or if there's a political change in the United States and a certain regulatory framework sticks this way versus that way. That's a sensitivity analysis to one thing. A lot of businesses, of course, do sensitivity analysis to different, views of what you think the long-term energy prices are going to be for your business. Contingency planning is, what would I do in my business if suddenly X happened? And again, X is only one event, right? So that's different than scenarios. That's different than saying if the entire business environment changes, here's how I would be positioned. It's saying, if it turns out that we own a lot of real estate and the tax rules change, what will we do if the tax rule changes in the following way? That would be contingency planning. And the oil industry does a lot of modeling on decision making under uncertainties. And that's when you have a variable or a set of variables and you say, the probability of X happening is 50%, whereas the probability of this tail risk is 10%. And then you're able to actually use those probabilities, those mathematical probabilities, to understand your business risk and how much return you need given the risk you're taking. So that's how businesses that are used to doing those different kinds of things. And scenario analysis is a little more complicated, and you have to establish different kinds of parameters. So if you go on to the next slide, before you set out on your exercise to sort of create your internal vision of how you think the world might change over the next 2 decades, say, if that's your time frame, your first question is, what is your time frame? You're talking 10 years, 20 years, 30 years. I recommend people doing 2-degree scenario to, think through what you think the world's going to look like either to 2040 or to 2050. Scope, you're looking at the global markets? Are you looking only at the United States? Are you looking at a particular narrow market that you're in or you're concerned about? And then drivers and influencers, I'm going to show you that in a minute, which is sort of like, to get yourself started, because there's so many complex things that could be involved. To get yourself started, the first thing you want to do is think about what you think are the main drivers so that you can sort of establish the quadrants for your storylines, the sort of like the frame that you're going to use to put your different variables in. And then when you're thinking about specifically a 2-degree scenario, I think you want to then map out in terms of your questions that you're going to answer in each of your, aligned storylines is, what is the CO2 level that's permitted or you're going to use as your reference case? And then how does that differ from your 2-degree scenario case? And then you want to think about, when I talk about abatement choices, so what kind of technologies or policies or restrictions are going to be involved that will lower emissions, either through technology or through different practices or through different procedures. And then you're going to compare those choices compared to different scenarios for what policy is going to be around and what the potential technologies that are going to be available. And then the last step is to quantify how those ranges of impacts are going to affect, depending on who you are. If you're an institutional investor, you're going to think about how those events are going to affect the asset classes that you're investing in. How might it affect the stock market? How might it affect your private equity holdings? Is it a risk to your real assets portfolio? A lot of investors today are making their top return by investing in real assets. Well, those are long held assets, and the value of those assets might change over time as climate change risk either comes in or new opportunities that might come as people, prepare for new regulations or new opportunities that come from the transition or technologies. So that would be something that would be important for an institutional investor that has a real assets portfolio. And then if you're a Fortune 500 company, when I use the word CapEx, because that's how the industry thinks about its spending. But, what are your long-term capital projects? If you're in manufacturing, have you taken into account 3D printing? Have you thought about how 3D printing is going to affect your competitive landscape? If you have to lower emissions, have you thought about, how 3D printing is going to play into your future emissions? Those kinds of issues. And then as you go through the exercise, what it's going to allow you to do, and that's really the key reason that this is a superior way of looking at complicated risk, is it's going to allow you to think about what are these key levers, either the key things that could upset your business or the key levers you have to create an opportunity. And I can tell you in the oil industry space, there have been a lot of companies, and in the Q&A, if people want to have a specific example, I can give you specific examples, but there are a lot of companies that went through this exercise specifically to get their shareholders off their back. And then when they did the exercise, they realized that either they were missing an opportunity that they could really tap. In the case of Statoil, they suddenly realized that because they have all these amazing offshore technologies, that they might be able to be a leader in offshore wind. And when they assessed how they thought Europe's regulatory environment was going to change and the position of all their resources and businesses, they realized that they weren't just doing this exercise to get some of the Church of England and their sovereign wealth fund off their back, that actually there were real benefits they could have from adding a new energy division, which they did. And even with the U.S. companies, some companies have short-scaled their investments, so they're not doing these 20-year or 30-year projects. They're focused on resources that they can produce in the next 5 to 10 years. There are other companies that have, like Total, that have pivoted into batteries and other clean tech businesses. So people, who go undertake these exercises find that there were true risks to their businesses and there are opportunities that they were letting smaller competitors take advantage of. And it's a real exercise. And then, the next step is, how do you develop these alternative strategies, and how do you assess where you are? So say you create these 4 quadrants, which I'm going to show you on the next slide, and you have these 4 possible storylines of the kind of world that you might be operating in. How do you then think about which of those storylines is going to be closest to reality, and how does that fit with the business decisions you're making? And, different companies have set up these very interesting systems, some of them quarterly, which they report to their board of directors to report on which of these quadrants are we closest to, and how is that affecting our strategy, and are we positioned? And as you realize, if you realize through going through the process that you do have material risks, then as you have to sit down with your legal team and figure out, what is the appropriate level of disclosure that the business should be making about those risks, and how are you going to engage investors to explain the competitive advantages you have now, or how you are dealing with these risks. And again, in the oil and gas sector, Bloomberg just had a set of reports where they, Citibank actually put Exxon as a sell, and their main justification for that was not 100% what Exxon's performance relative to peers, but it was a concern that Exxon was not producing its senior management and a concrete resilience approach compared to other companies of its size class, which were providing their CEO on a regular basis to investors, had clear vision and explanation for how they'd assess certain risks and what they were doing about those risks. And so even though Exxon, put together a pretty outstanding, dozens of pages document about their 2-degree scenario assessment, it was a pretty sophisticated document, I have to say, because the management was unable or unwilling to tie that exercise to their vision of Exxon's future. The market kind of rejected their efforts. So, that's also an important part of it, is deciding, what is the appropriate level of disclosure, and how do I want to present myself to my shareholders and to the outside investment world in terms of understanding that I've assessed risk to my business and I'm forward looking. So if you go to the next slide, and I know my time's starting to run low, so I'm going to sum up quickly, but just to give you an idea, if you were kind of create a scenario planning exercise, for the 2 degrees, what might you look at? And so this next slide shows you a matrix that you might use to create sort of your 4 alternative worlds. And you can see that one of them would be we stay with current policy, but there's extensive technological breakthrough. You could imagine that could be a realistic world. But you could also see, 4 years from now, we go to a much more stringent global regulatory framework. China's moving in that direction, and maybe others follow its lead. So, or maybe the United States adjusts its policy. So, that would move you into the quadrant to the right. And then, of course, if we had less stringent policies and less technology breakthrough, then, you have a very different world. So I think you can see from looking at those quadrants that why it is that this methodology is really going to give you a different view of the world than just stress testing your business strategy against one contingency or against one, change in price outcome. And then
Amy, thanks. This has been great. I'm worried that we might be running a little bit short on time. Maybe we can handle some of this in the Q&A. I'm not sure if there's additional information that Kaitlyn wanted to kind of contribute to this, or maybe we could then catch up on more of these details in the Q&A portion, if that sounds good.
Yeah, I can. Oh, go ahead, Amy.
I think Kaitlyn should just talk a little bit about the reporting process.
Right.
Well, yeah, and I was actually just going to add a little bit of additional context here. Amy's framework is definitely, I think, probably one of the most advanced out there right now. And I just wanted to highlight that with the TCFD's recommendations coming out, even the TCFD says, this is still a very, relatively speaking, a new area, taking scenario analysis and applying it to climate scenarios. So there's certainly a lot of work to be done in this area. And I also wanted to just highlight that, every company is different. We're, of course, focusing on oil and gas here, but there are a lot of industries for which there really aren't best practices yet in this area. And the TCFD does recognize that and recognize that this is going to be an ongoing process as folks start to really drill down and practice this, particularly in other industries. So that's all I would add at this point. If we can handle the rest in questions, that's totally fine.
Great. Thank you so much, Kaitlyn. With that, I think I'm going to pass it over to Libby to talk a bit about her work at TrueCost, which is S&P Global Company.
Great. Thank you very much, Nancy. And if you could go on to the next slide, I just want to provide a bit of information about TrueCost. If there's anyone in the audience who's not familiar with our organization, we are part of S&P Global, which is the largest provider of data and ratings to the capital markets. TrueCost is a business unit that sits within S&P Dow Jones Indices, and I manage our global business. And we work with companies, multinational companies, and investors to help them understand and value climate change, natural resource risks, water scarcity, and a broad array of environmental, social, and governance factors, what we call ESG issues. We have been doing a number of scenario analyses for a variety of applications, whether it's an equity investment portfolios, such as what Amy was mentioning, where we're looking at a 2-degree scenario around a portfolio, or as part of stress testing that banks might do on their lending, or as what I'll focus on today, working with multinational corporates to understand the business case for investing in more sustainable solutions. So our focus at TrueCost is really on the quantitative analytics that would inform scenario analysis that Amy described so well. And really our aim in doing this is to help companies and investors understand how to direct capital towards more sustainable business models. So you heard Nancy mention early on about their research report, really well done, on a low carbon economy. And our point of view is that we are actually in the midst of a transition to this low carbon economy, and companies need to think differently about their business models. Companies should be conducting scenario analysis to understand climate risks and opportunities under a range of situations. And by doing this, the benefit, of course, is that there'll be a better understanding of the timing, the magnitude, and the location of these financial implications. So what I'll share in the next 10 or 15 minutes or so are some frameworks that we use to understand how these environmental and social issues get translated into financial costs. And then I'll provide a few case study examples, 3 case study examples, looking at, I tried to pick a range of situations, and then also just some resources for those of you who are getting started. So if you can go to the next slide, I want to share, first of all, some of the ways that we are thinking about using scenario analysis to understand these climate-related risks. And I should mention also that S&P Global was part of the TCFD and participated in the task force, developing the recommendations and the like. So we are very familiar with the recommendations by the task force. And again, from our point of view, the challenge and what's been evolving and what we're trying to work out as well is how to translate these climate-related issues into financial costs. And our approach has always been to understand what the environmental and social issues are, and then understand, again, and quantify in monetary terms how that may affect either the P&L, whether there's an increased expense or a loss in revenue that may affect the P&L, or whether there is a decreased value in assets that may show up on the balance sheet, or whether there would be reduced cash flow, for example, that would show up on the cash flow statement. So the example that I'm showing you here is some work that was done a while back with the Norwegian government to understand the potential financial implications of their investments, their direct investments, in a very large number of listed equity companies around the world. So again, this is the way that we tend to think about these kind of issues at TrueCost, is being able to take an environmental issue and then understand how the external costs become internalized either on the P&L, the balance sheet, or the cash flow statement. And if you go to the next slide, I'll illustrate another way that we look at these kind of risks. And this example I pulled has to do with primary production and for 4 different food commodities. And the situation here is that we wanted to understand the potential implications on credit risk. So the endpoint that we were driving for was really to understand what credit metrics would be potentially at risk in terms of profitability, liquidity, or solvency of the company. So the starting point for that, and the way we often approach things, is to understand, first of all, the business model and how production occurs, and then to quantify and value the environmental and social impacts and benefits associated with the production system. And from there, we then start to define what kind of scenarios might be important, whether it's scenarios related to the business practices. For example, are there ways that these commodities could be harvested using more sustainable practices? Or we might look at different transition risks like carbon pricing, or we might look at physical risks like too much or too little water. And we then, again, work towards quantifying and valuing and understanding how those environmental risks get translated onto the P&L. So again, just another example of how we look at these issues. So if you can go on to the next slide, what I'm going to show is some of these applications in practice. And I'll go through 3 examples. If you can go to the next slide, please. I'll show 3 examples of how we are looking at these environmental costs. And I'm going to start, these are all publicly available. I'm sorry, if you could go back 1 slide, please. Thank you. These are all publicly available examples, and I've included the links in the slide, so you'll be able to get more information from our website on all of the details about how we go about this. But I'll start with one example on carbon pricing risk related to policy implications, and then I'm going to go through a water example, and then I'll end up with an example that looks at a broad range of environmental risks. So when we look at carbon pricing risk, what I'm showing you on this slide is simply the framework for how we think about carbon pricing risks related to policy. And we are looking at both direct carbon pricing risk that a company might realize because of a tax or an emission trading scheme, as well as costs that they may realize because they're paying more for energy, as well as costs in their value chain. So it could be a pass-through cost from their supply chain, from their suppliers, or it could be through reduced demand for energy-intensive products. And if you can go on to the next slide, I just want to illustrate some of the work that we've done recently to look at this carbon pricing risk in a number of different industry sectors. We launched a corporate carbon pricing tool back in August of last year that helps a company look at 3 different climate scenarios and global carbon pricing risk for their business operations. And what we did as part of this slide that I'm showing you is our hypothesis was that these carbon pricing risks were real, they were financially material, and that we wanted to understand if the current measures that companies use to track these risks are worthwhile, which of course, to some extent they are, but I'm showing you the results from how we ran the carbon pricing risk tool across 60 chemical companies. And what I'm showing you in those yellow bars is the projected profit at risk in 2030 under a 2-degree scenario. And then the black dots illustrate the company's carbon intensity or footprint. So you can see from these numbers, by 2030, on average, about 30% for the sector, on average, profit is at risk. So if you're an investor looking at the chemical sector, there's first of all a lot of variability within the sector, and then also for individual companies, there are some significant carbon pricing risks that need to be hedged or managed. And the other finding, of course, from this analysis is that a carbon footprint, the traditional measure of carbon pricing risk that companies rely on, is not always a good proxy. So I'm showing you there the large bar for one of the companies sort of to the right on the slide has a relatively high carbon intensity. Low carbon intensity, but a high profit at risk. In contrast to the company on the far left-hand side, which has a rather low intensity, but quite high profit at risk. So again, just an example of how we are looking at quantitative analytics on carbon pricing. And if you can go on to the next slide, I just want to share that we are looking at these pricing risks across the value chain. And this illustrates the work for the automotive sector, showing profit at risk from 2017 projected out through 2050. And again, this is under a 2-degree scenario. We typically look at several different ones, but the point I wanted to make here is that, again, it's not just about direct operations shown there in dark blue, but that profit at risk can be significant for energy-intensive products, and we're seeing quite a shift, a projected shift in changes in consumer behavior because of decreased demand and increased taxation on fuels. So those are two examples of carbon pricing risk. And if you can go on to the next slide, I want to illustrate some work that we have done to value water-related risks, in particular water scarcity, arising as a result of changing climate, as well as water pollution. And so this collaboration was work that we have done for the past 3 years with Ecolab and Microsoft to create an online publicly available tool that allows for asset level analysis, looking at various drought scenarios and projected water scarcity at a basin level across the next 10 years. So again, I just want to illustrate that what's often forgotten in many climate-related discussions is that one of the big implications will be around water and its availability. And there are good tools out there, such as this one, that allow companies to project and forecast what the lack of fresh water means to their operating expenses and potential for loss in revenue. Those are the two key metrics that this tool provides. And then if you can go to the next slide, I just want to illustrate some work that we have done with ICBC, the largest bank in the world based in China, looking at the financial costs associated with aluminum production. And this is a scenario analysis and quantitative analytics that we provided very much in line with how Amy was describing scenario analysis, where we're looking at a broad range of environmental issues, not just carbon emissions, but also air pollution and water use, and then looking at several different scenarios, 6 potential scenarios in this case, and looking across at 12 projects related to aluminum production and taking into account various abatement technologies and the like. And the results of this analysis are available online. They were published last year, but the process involved the steps that Amy lined out, looking at the key components, understanding what are the impacts, what are the types of risks, setting out the risk factors, and then understanding and quantifying how those risks can be realized as actual financial costs, and looking at that under various different scenarios. So again, I encourage any of you who are interested to go to the website and get these documents, and you can get into the details about any of the assumptions, the detailed results, and the like. But in this case, we were looking at scenarios involving environmental taxation schemes, emission trading schemes, revenue at risk from water scarcity, and imposition of new abatement controls, as well as just general policy and compliance. So those are the 3 examples I wanted to share with you. And if you go on to the next slide, I just wanted to also indicate, for those of you who are getting started, there are a lot of resources available, of course, through C2ES, and Amy's work with Series is a great guidance document. We also have a number of papers and research on S&P's websites. The links are all embedded here. So we've got information about TCFD recommendations, as well as specific information on carbon pricing risk. And then, of course, case studies that I mentioned, the one for the aluminum sector. There's also analytics for the coal to chemical sector. And then we have a number of tools that are available, whether it's the carbon pricing tool or water risk monetizer, or actually our tools for investors. So I encourage those of you who are just getting started to take a look at some of these resources that are available. And I'll wrap it up simply by sharing a few observations on what we've learned. And I think to echo some of what Amy said is that a lot of the benefit of the detail that we're doing and providing science-based, data-led information is really to ground what can often be abstract conversations about a future condition with some data. And having data be part of the decision-making process, and having that data actually based on scientific information, we find is often a good way forward to engage with other business units for example, your procurement team that may be unaware of the rapid change in carbon pricing risk that will affect the cost of energy that they're going to buy. Or perhaps the corporate risk function, the enterprise risk management team, may not have fully had a conversation yet about climate-related implications on physical assets. So we find that having some quantitative data often grounds these conversations and makes them much less abstract. The other comment I would share with you is that there's a lot of information out there, and these analytics and data sets can be quite overwhelming. Our experience has been to take what is already existing information and data available on future conditions and use that as a starting point to prioritize. And then from there, where there are material risks, that then becomes the time to start to refine with local data or very much more precise information about the specific business model. But if you begin looking at the world and trying to create all of your own scenarios, we do find that that can be quite overwhelming, and it really is important to take advantage of what's already been done by scientists to create data sets on environmental conditions, for example, or water scarcity and the like. And then my final thought to share with you is simply that there are some blind spots to these risks and opportunities that are currently in place by relying on some of the metrics that all of us know and love so well. For example, carbon intensity footprint has some blind spots to carbon pricing risk. And we also know from our research that having a view not just of direct operations, but of your value chain is very important. So for example, in the carbon pricing risk research that we did, we know that the pass-through costs in some industries will comprise about 30% of the pricing risk. So it's not just about your own physical assets, but it's also about what's upstream that you're buying from suppliers, as well as what's happening with your products downstream. So Nancy, I'll turn it back over to you, but hope this was helpful in giving some frameworks for how TrueCost is thinking about these scenarios, as well as some case study examples, and hopefully some resources for people who are getting started and wanting to dive into this work.
Thank you so much, Libby. Lots of information there that I know we'll have lots of questions to talk about when we get into our final session. We've gotten a lot of questions about the slides. Those will be available on YouTube when we post the video. So that's one of the most common questions we've gotten. So I just wanted to go ahead and say that before I pass it over to Mackenzie, who is going to be talking a bit more broadly and also more specifically about the FSB Task Force's recommendations specifically on scenario analysis. JP Morgan Chase was also part of the task force, so she should be able to shed some really good insight for everyone on this. So with that, Mackenzie, take it away.
Yeah, thank you, Nancy. And I'll try to be quick because, you know, a lot of this has already been touched on. But so I sit in the Sustainable Finance Group here at JP Morgan, and we work to integrate the firm's sustainability strategy into all parts of the business and its operations. And so, you know, in that role, we work really closely with our risk management colleagues to navigate environmental and social risks, including those related to climate, as well as our lines of business on building solutions and identifying opportunities in the transition to a low carbon economy. Our team also manages JP Morgan's external reporting on environmental and social issues, and that includes climate. And so that's kind of where this comes in. You know, we have a very unique perspective in that we interact with many clients around environmental and social issues, and we also disclose on environmental and social issues. And so we really are a user of information and a reporter. And so part of that is the conversation on scenario analysis data and output. So one of the reasons why the financial industry has started to look at scenario analysis in a climate context, because it has a lot of experience with scenario analysis in other contexts, is due in part to the recommendations released by the Financial Stability Board's Task Force for Climate-Related Financial Disclosure. So I'm going to abbreviate that going forward. But these recommendations sought to develop a consistent approach to disclosing climate-related financial risks. And Matt Arnold, who's the head of the Sustainable Finance team here at JP Morgan, was on the task force. And so, you know, we have a lot of familiarity with kind of the conversations around it and with the recommendations themselves. So folks have given a really great overview and a lot of specifics on kind of what scenario analysis is and what it can do. And my goal is really to give a little bit of insight on how the financial industry is thinking about it and some of the challenges that we've come across as we've started to tackle this in a climate context. So for a little bit of background, very high level on the TCFD, just to give context for why scenario analysis emerged as a tool for financial institutions. Several years ago, Mark Carney from the Bank of England took an interest in climate change and essentially began to explore the degree to which financial markets were integrating considerations about climate risk into lending and investment decisions. And he essentially was asking, is there a buildup of carbon risk in the financial system such that in the case of a climate event, there would be a significant impact on companies and the financial industry? He was not the only one exploring this question. A lot of NGOs were also talking about this. But out of this conversation, the industry began to think about ways to help lenders and investors think more strategically about climate change, in addition to a whole host of other risks and issues that they consider, but when making business decisions. One of the strategies that emerged was this notion of improving the effectiveness of disclosure in financial filing. And so it was in this context that the FSB created the TCFD with the specific objective, as Nancy had noted, to develop recommendations to guide more effective voluntary disclosure from companies around climate-related risks and opportunities. So the task force released its recommendations in July of last year, and one of the recommendations, as we've been talking about, that has received the most attention has been the one around scenario analysis. It should just be noted a couple quick things about the task force. The task force is still ongoing and is now more focused on helping companies think through how to implement the recommendations. And they've convened a number of industry working groups that are identifying, you know, what pieces are working well and what pieces are not, because this really was a starting point. But that's also why this conversation today around scenario analysis, best practices and challenges and case studies is so useful to just really continue that learning. And so, as you can see on this slide, this is a very high-level overview of the recommendations, and so I won't go into them deeply, but they're structured around 4 thematic areas: governance, strategy, risk management, and metrics and targets. And so for governance, it's really, you know, how do you govern climate-related risk? And this includes board oversight and management's role in assessing those risks. Strategy, how could and do climate-related risks and opportunities impact your business? And so this is really where you dive into the actual and potential impacts of climate-related risks and opportunities over a number of timeframes and scenarios. And so this is where we get the scenario analysis recommendation. Then there's also risk management. So really, how do you identify, assess, and manage those risks? And then metrics and targets, you know, how are you measuring those risks and opportunities? What metrics and targets do you have and do you use? And as we noted, you know, this guidance was structured to all sectors, and then it had some supplemental guidance for specific industry sectors. So for the financials, and then as well as other sectors like energy, transportation, materials and building, and agriculture, food, and forest products. And so as part of this discussion about how these risks and opportunities are integrated into business strategy, the TCFD recommended that companies undergo climate scenario analysis. And it asked companies to assess and discuss the potential impact of different scenarios, including a 2-degree climate scenario, on the organization's business strategy and financial planning. And so as we've been digging into the recommendations, you know, we've really had a lot of experience in kind of thinking through our approach to scenario analysis and kind of some of the challenges. As we've noted, you know, scenario analysis and stress testing in the financial industry is not new, and it's not new in a lot of other industries, but it is new in this context. But so for background, each year large banks and other financial institutions evaluate and report their capital position under a number of financial scenarios through what is called the Dodd-Frank Act stress test, and that's U.S. specific. And this is, both in the context of these recommendations, this is both a fantastic and opportunity and a little bit less so, only because financial institutions, have teams that are intimately familiar with scenario development. However, these efforts have not traditionally been used to assess and stress climate-related risks. And as we've talked about and folks have mentioned, it's this translation between climate risks and financial risks and impact that has kind of become one of the primary challenges in utilizing scenario analysis. And so, while we have all these existing frameworks within our institution, I think a lot of folks have thought that this infrastructure could easily be tweaked for climate impacts and to assess them, and it actually may not be that simple. And so I'll get into some of the specific challenges that we've come across in a second, but as financial institutions approach scenario analysis in this context, I just wanted to note a couple things, and I think Libby just ended on this point, but it's a very important one. Scenario analysis is largely about developing a strategic risk management process that incorporates climate-related risks as one of many risks that businesses need to think about. And so it's really about kind of this journey and this process and establishing that within the business. But it's also isn't about getting companies to evaluate just one outcome. It's about how a company can fare in a variety of contexts and really thinking about it in this broader landscape of more than just a 2-degree scenario, but out kind of, more context. So overall, we obviously as participants in the TCFD and in talking to the rest of the financial industry, we welcome the guidance, and we know it's not perfect, but it is a really good place to start, and it's really helped to jumpstart a lot of really great conversations in disclosure, but also in just kind of risk assessment and integration. And we think it's a very important step and strikes the right balance in trying to promote more consistency, but also giving companies some flexibility kind of in the way that they report what best reflects their business. But there are a number of ongoing questions and challenges that have arisen from the recommendations, and especially as companies have started working to operationalize them, and especially around scenario analysis. So if you want to go to the next slide, this one's a little daunting, but the first big bucket, which is really a lot of what we've talked about today, is how do financial companies and companies at large implement the scenario analysis recommendation. This slide is a really good overview of some of the key considerations the TCFD recommends companies think about as they undergo scenario analysis. I'm not going to go through it, but it does give a good sense of some of the key questions and challenges that companies have to start asking themselves and exploring. And it also gives a good general view of the complexity of the issue and kind of how, it's not as straightforward as we might have hoped or thought. So as I mentioned, financial institutions are familiar with the concept and machinery of a scenario analysis. However, and this has been mentioned, climate-related risks are not necessarily easily translatable into financial risks. You can't just plug 2 degrees into a financial model and generate an answer. And the nature of climate change is one where it's actually manifested through a number of variables. One example, commodity prices can be impacted by policy, but also technology, and even potentially, a physical event such as drought. And that's a lot of different things to think about as you are looking at, one financial impact. Time frames are another challenge, and these have also been mentioned. On one hand, traditional climate models look out, 30 to 40 years. And the hard part is that the further out companies look, especially in decades, the more uncertain assumptions become. But on the other hand, existing financial scenario analysis infrastructure, such as DFAST, is only built around 9 quarters, which is not enough time to evaluate the majority of impacts of climate change, especially in physical impacts. And so it's kind of trying to figure out this middle ground of a middle time frame that works, but if you choose middle, it doesn't quite work with the existing infrastructure, but too far out, you get into a realm of uncertainty. Now, I'm not trying to say that the uncertainty in longer term analysis means that companies shouldn't think longer term about the ways the world could look and what it could mean to their business, because that's really the crux of scenario analysis. But it is important to be thoughtful in drawing conclusions from this work, and especially in a quantitative setting. And so that's something that, in thinking about how to use the outcome of scenario analysis, what does that mean? And how can we couch it in that context? I do want to take a moment in this kind of bucket of implementation to talk about one of the benefits that we've seen and a lot of folks have seen in tackling scenario analysis in a climate context, is that as we've kind of begun thinking through this translation question of articulating climate risk into financial risk, or seeking to balance, on time frame, what we're seeing is an integration of capabilities and expertise across financial institutions that previously didn't interact. So we have scenario developers and finance functions talking to risk managers and industry analysts in ways that they just hadn't been before. And this collaboration is really exciting, especially as we see people learning each other's languages, learning, what infrastructure actually does exist within the financial industry to do more analysis, to tackle more of these questions, and really begin to work to integrate this analysis into their institutions. So there's a lot of potential there that is very exciting. The second kind of bucket of questions, which I won't get too far into, is this debate about materiality. So what if a company does a lot of analysis and concludes that climate risk is not material in a financial sense to its business? And so that's where we start talking about financial risk, and that's very different from thinking about climate change as a material environmental issue. And the TCFD recommends that companies include this information in their financial filings, but there also may be good reasons to remain flexible about where it goes. And I know that there will be a webinar on this topic coming up, so I'm not going to go further into it other than just to plug the webinar, but also to say that it's a really important area to explore, and that that'll be a really good conversation, because it's definitely a big challenge when thinking through the outputs of scenario analysis and kind of how to communicate what we get and what we see once we get it. And then just really lastly, I want to touch on the fact that climate risk is really hard to measure. And this slide shows a lot of the complexity of it. But, we initially have this desire to assign one or two metrics that could, theoretically measure climate risk or account for it. And in practice, it's really a lot more complex. For example, you can't look at the amount of carbon emitted by a company and draw a conclusion about its future financial viability. You really have to understand the industry, their assets and business model, what jurisdictions they operate in, what regulations they're subject to, where they sell their products, a whole host of other factors and risks. And even then, you could have two very smart industry analysts look at the same company and draw different conclusions about its future. So there's really not one right answer. And so that's just kind of an overarching statement on thinking through scenario analysis and the complexity of it, and knowing that, this is really just a journey, and that we don't want to start to draw the wrong conclusions out of something that is supposed to kind of help us and guide us in thinking about climate as it relates to our business strategy. And so lastly, I just wanted to end by saying that, we see this exercise as the start of a marathon, not a sprint, and that's really where the task force recommendations are also going. They provide a really great framework to start tackling these questions and asking important questions. And a lot of, the work that we've seen and we're taking the time to tackle, we know that it won't be perfect right out of the gate, but the financial industry is really, looking at this as a learning process that will build on our capability over time. And we see that scenario analysis is actually a good avenue to do that. So with that, I will turn it back to Nancy.
Thank you so much, McKinsey. Lots of great information from McKinsey and Libby and Amy and Kaitlyn. So I know that we had a lot of questions come through. I have a few questions up here on top. I think actually we covered a lot of these in the course of the content. So I might just ask one precursor question before getting into the ones that I got from the online participants. But one of the questions that came up, I think, when we were talking about pulling this whole webinar together was what types of companies are actually using scenario analysis to analyze climate-related risks and why? Are all companies doing this? And so I was curious if a couple of the panelists might have comments on that and be able to share that with our participants.
I can start, Nancy, if you'd like. This is Libby. I would say that we're seeing a broad range of companies across multiple industry sectors looking at climate-related risks. Not necessarily in response to TCFD, though that is in the background, but we are seeing companies that are water intensive use these kind of scenario analyses. So pharmaceutical companies, for example, food and beverage companies, and even companies that manage data centers are using these kind of tools to understand water-related implications to their business and what might happen under future climate scenarios where there isn't enough fresh, clean water to run their operations. On the carbon side, again, we're seeing a broad range of industries, even service-related industries, looking at carbon pricing risk simply because they are starting to understand that the kind of energy they buy may actually have financial implications around simply their expenses in the future. So we're seeing it not just in heavy industrials, but also in a broad range of sectors.
Thanks, Libby. That's really helpful. I don't know if anyone else had a comment. If not, I can go ahead and ask a few of the questions that I have.
Amy and Kaitlyn, let me just say this, and maybe Kaitlyn can give a few more examples. Kaitlyn and I believe that this is going to be the standard of practice in the energy industry going forward. And I say that not just oil and gas, but also the electricity industry and even some of the companies, car companies and other sort of industries where battery technology or the use of energy is a major factor in how consumers interact with the product, ride sharing. So I think it's going to become a standard of business practice. If you're not doing this, you're going to be considered a laggard. And Kaitlyn, I wonder if you could talk a little bit about some of the work you've been doing on CSR and how you see the industry responding.
Yeah, thank you, Amy. And I did. I know you asked me before about reporting process, and I'll hit that as well. I think we're seeing a lot of demand, mainly because of from the investor side. Investors asking companies to begin to disclose this sort of thing, actually mentioning the TCFD in letters to companies. And I think depending on, of course, a lot of this super majors have already been at this, working with Amy in a lot of cases. But I think some of the other more mid-sized companies are really just starting to get a handle on this. So I think you're going to see a lot more companies adopt this as a common practice, as Amy said. Particularly, I think something we haven't talked about is that the TCFD's own timeline is 5 years for uptake. I mean, it's very quick. They want to get a handle. I think from the financial perspective, they really want to get a handle on the risk to the stability of our global financial systems as it relates to climate. So it's a pretty quick timeline, and I think It's certainly aspirational, but and to just tie into the reporting piece, what we've been working with a lot is strategy, and how do companies sort of adapt as this world keeps changing and the expectations keep changing. You've got so many frameworks out there, and I know a lot of our corporate audience is very familiar with the concept of disclosure overload. And I think there's probably a lot of questions about which framework can I use to meet this requirement. Well, the answer is they're all trying. GRI and sort of all the big ones, CDP, SASB, they've all released statements of support for TCFD and are quickly working to change their standards to reflect the TCFD recommendations. And I think you're going to see that. I think the first one is coming out this year. I think the 2018 CDP request is going to reflect some of these, some of the TCFD recommendations. So you're going to start to see these frameworks that have been around a long time reflect TCFD. And I think from the strategy standpoint, companies that can remain agile and respond, again, basing everything in materiality, and not necessarily going beyond that, but those that are able to respond and remain adaptive as these expectations change, they're the ones that are I hope, going to be most efficient at addressing these and also reap the benefits of doing scenario analysis and reporting some of the other information as well.
Great. Thanks, Kaitlyn and Amy. That was great additional color. Another clarifying question. Actually, I'm going to lump these two questions together that came through. I suppose we started out talking right away about 2-degree scenarios, but there was a question about, does 2-degree scenarios mean you're trying to limit to 2 degrees Celsius? So I can answer that as yes, but some of the panelists might want to elaborate on that. And secondly, what made you choose 2-degree scenario in terms of your reference point for analysis?
Well, let me, Amy, let me take that on. So, 2 degrees was the standard that's used, though there's some other ambitious conversations about going to 1.5 degrees warming. Was part of the framework for the Paris Accords and for sort of a global pledges per country around the world. So the idea is each country would contribute reduction in emissions in such a way that when you add them all together, you will limit the warming of the atmosphere of the Earth to 2 degrees. And the 2 degree selection is a science-based choice based on the sort of latest science consensus on how much warming would avoid catastrophic changes to weather and the Gulf Stream and drought, water, disease related to insects, heat, and so forth. So that's really the goal, was established globally and through the IPCC, the UN IPCC, as to what would be an appropriate target. And when companies think about that conceptually, it's trying to align your business and the future of your business with the kinds of metrics that countries will use. And also, I might add, because I think this was discussed by some of the other speakers, even beyond the Global Climate Accord, you have major players, whether that's cities, are taking a strong role in trying to assess their contribution to climate change. Something like 70% of future emissions are going to come from cities. And so you have major cities all around the world, and not just in the United States and Europe, but throughout Asia, that are assessing, what's their transportation policy, what's their own energy use policies, what technologies are they going to favor, how are they either going to tax or limit emissions from companies operating in their jurisdictions. So these subnational players are also important. So when companies are trying to figure out their strategy, it's a combination of what the true cost folks do, which is to, first think through, are there going to be physical limitations to water, or are there going to be regulatory limitations to water? And if there are, given where my facilities are, how much risk do I have? What do I think there's going to be pricing to water, and so forth. So that's one layer. But just in terms of emissions, I think increasingly in the oil and gas sector, companies are moving towards reporting their methane emissions and what they're doing to reduce them. And Kaitlyn's worked with a number of companies, even if they're not having is it material to their business in the next 3 years? Maybe not as much, but having most companies today have a sustainability program and a reporting out to the public. Some of that function is engaged in their investor relations function. So having your website properly reflect everything your company is doing in terms of doing a carbon assessment, knowing what your emissions are for both yourselves and your major suppliers, understanding what steps you're taking to reduce that over time. Even though it may not be required today, there's some, depending on your view, that maybe it'll be increasingly regulated in the future. So just trying to think about how do we even position ourselves. A lot of companies haven't even done a water inventory or haven't done an emissions inventory. So that's a really, important first step. And then, working with someone like Global Associates to try to think about after you've changed, what do we want to convey to the public? How is that important? If we're a consumer-facing company, of course, that's much more important. But even for all companies that are in public and equity and debt markets, it's going to be increasingly important.
Thanks, Amy. That's great. We got another question. Mackenzie, I wonder if you might have a comment on this because it goes back to some of what you were talking about in terms of timing. We had a question in terms of how far is maybe too far out in terms of considering scenario analysis. Is 50 years, 100 years? What's too far?
Yeah, I think that what we struggle with in that is not necessarily that we have an answer to what is too far, but once you get into 30 to 40 years, the assumptions that you have to make for a scenario are pretty wild. And it's really then you're just kind of in the land of uncertainty. And that's something that, for the financial industry is really hard to make then, to have the output based on that uncertainty and then have the output be used, to make definitive business decisions. And that's part of why, we do feel like, that's part of why, it's been a challenge in figuring out what is a good middle ground in terms of time frame where you can capture a good chunk of impacts and actually really do run the analysis, but without, going to the realm of essentially guesswork. And so that's where, one thing that I've heard talked about is not necessarily a climate scenario, but scenarios based on other things, and thinking through, more tailoring some of these analyses, kind of to what Amy had said earlier, is maybe less scenario, more sensitivity testing, but those do come out they do produce different outcomes and different results. One's much narrower, but there is a question to be raised of, is climate scenario the best, or are there other versions of that would maybe produce a little less uncertainty in the time frame? But that's definitely been a challenge. I think we've also been constrained by existing financial stress testing, which, like I said, is 9 quarters, which is barely any time to assess financial impact. And so that's kind of the tension that we've been having.
Let me elaborate on that, because I think you set up the question perfectly. So, obviously none of us know what's going to happen in 30 years' time or 40 years' time. But there's a tendency when we take the 3-year view or even the 1-year view, and I can say this is definitively the case in the oil and gas industry, maybe in the pharmaceutical industry or some consumer-focused industries, there's more flexibility. But people make a judgment, tend to have a bias that the future is going to look like the past. And in the oil and gas industry, there's a lot of repetition of pattern, and so that seems a little justified by history. But we do know that we're experiencing different technological challenges and disruptions, and we do know that weather patterns are changing in ways that were not expected, might have been expected by someone in the science community, but not expected by people who are investing in real estate and other things, even shipping. So what you're really trying to do is pick a forward enough framework that you're going to, sort of guesstimate different trend lines that you can already see. You're gonna play out in your mind what you think those trend lines are, and then you're going to work back from those trend lines what you think is going to happen to your business today based on those trend lines. And I think that is really the benefit. The benefit is not I'm putting down a facility and I have to decide whether that facility will be profitable in 30 years. It's really about I'm making an investment today, and how fast do I think that investment could become obsolete? So you're really trying to use your forward-looking analysis to assess your risk to current activity.
Great, thanks, Amy. That's a lot of great information. I have one more. We're close to the end of our time here, but I have one more quick question for Libby, and then I have a more general question that's really more of an opinion for the rest of the group. Libby, there was a question in terms of what TrueCost, what sectors you guys cover in terms of your risk analysis.
So we take a holistic view. So we work across every industry sector around the world. I will say that there's industry sectors who are more predisposed to looking at these kind of issues than others. So, for example, any kind of heavy industry or any kind of industry sector that relies more on environmental resources to generate revenue tends to be a company that is looking at this much more closely. And of course, any industry sector, like extractive industry, that is very energy intensive, tends to look at these issues. But in terms of the businesses that we work with, we are working across a very wide range of industry sectors around the world, whether it's real estate, service businesses, extractives, industrials, or the like.
Great, thanks, Libby. And then to close out, I have maybe a more provocative question that was asked by one of the participants. And I'm going to ask this to all of the folks on the line. Feel free to respond if you have an opinion on it. But I'm curious, in terms of the argument that climate risk disclosure could potentially lead to unintended consequences, such as investors downgrading other risks. Do you think that this is a potential issue with climate risk disclosure?
I guess I'll take that on, since I've been practicing, political risk consulting and geopolitical risk consulting for the energy industry for, decades. It's just one of many risks. And, I think that's why people use this term ESG, right? Environmental, social responsibility, and governance risk, because, climate is just one risk among a wider range of risks. And I don't think that I think that people focus on it now because it's becoming a, post-Paris and given, China's new industrial strategy in the clean energy space, people are understanding that there could be a lot of disruption coming forward. And so there's more focus on that today than there has been in the past. But I would tell people it's not that different, especially, we were talking about banking risk and other financial risks. It's not that different. I mean, you have sovereign risks that you have to take into account in your business if you're a global business. You have a currency risk, which people are comfortable taking. I think a lot of businesses today have a better understanding that energy changes in energy prices are a huge risk. Commodity prices are a huge risk to their business. I know a lot of boards now have a commodities expert on the board because commodity prices are such a large risk to their business. So this is just an additional risk, in my opinion, that has to be studied carefully. And it's one of many of those risks. And some of it's integrated in terms of how, climate change might increase, a sovereign risk in a particular location that's not have a good policy in terms of resilience of population to physical risks. But it's within a spectrum of risks, and I think the reason that the investment community and Mark Cummings and others, so focused on this risk in recent years was that, with the financial crisis in 2009, there was a tremendous emphasis on identifying, many different kinds of risks, but not this particular risk. And so I think it's just, correcting for that. And, again, just pitching for the scenario analysis. And you can take off-the-shelf scenarios and then run those scenarios across your business and think through how your business is going to fare in these sort of, we do that sometimes with companies. A lot of companies, just in the energy industry, just use the International Energy Agency scenarios and then run their businesses against those. But the process of doing it organically inside the company can be useful because you know your business better than McKinsey or some of these off-the-shelf scenarios. And by you actually projecting, I tell you the story of ConocoPhillips. ConocoPhillips literally had the people who were handling their scenario analysis go out and tour Silicon Valley and do some other deep dive researches to get their own view of what they thought, what disruptive technologies they thought were coming and other kinds of policy changes were coming that they thought would affect their business, their own internal view. And then they used that internal view to inform the quadrants that they set up. And you can see their quadrants on their website. They did publish it on their sustainability webpage. And, it helped inform management. In the case of ConocoPhillips, I don't know if they, would say this, but my opinion is from the outside that that is one reason why they got out of their oil sands investments in Canada, for example. And they were able to sell them, whereas a company that, maybe was slower at doing this exercise might get to the point where they can't actually sell their oil sands resource business because now it's a less considered a less desirable business. So the point is to be sort of ahead of the curve, especially if you're going to have assets that you're going to need to liquidate.
All right. Thanks so much, Amy. I think we're going to have to actually close here because we're already 5 minutes past our time. But I just want to say a big thank you to Amy, Kaitlyn, Libby, and McKinsey for sharing so much of their expertise and the work that they've been doing in this space. It's a huge and growing area. As McKinsey mentioned, this is just the start. We imagine that this will evolve as companies start doing it more. And get more experience with it. And just one more plug for our webinar on the legal risks around scenario analysis, which is scheduled for March 12th. So feel free to find that and register for it on our events page on our website. And with that, just like to say thank you and hope you dial in again soon.